Hello everyone, and welcome back. In today's video, we're going to be talking about MakerDAO. Now, I know what you're thinking. Maker is generally seen as boomer DeFi. It's really not that exciting. It's really not sexy, but I would actually argue it's pretty much the best way to borrow against your ETH. Now, as I mentioned, I pretty much wrote off MakerDAO as a non-interesting product, but I would actually argue they've done a ton of revamping to the protocol over the last few months, and they've added a ton of different collateral types that actually make MakerDAO very compelling if you want to borrow against your assets. So to access Maker, you're going to want to go to the Oasis app, and you're going to be presented with two interesting features on Maker. So the first option you have is you can multiply on Oasis, and the second option is you can borrow on Oasis. Now, the multiply option really could be its own topic, so I'm actually just going to focus on the borrow section here. So Oasis, and I should say Maker, has added a ton of different new collateral types that you can borrow DAI against. And in my opinion, the most compelling option for collateral here is the Wrapped STETH collateral option. So why borrow against this Wrapped STETH token? Well, Wrapped STETH is staked ETH, which means it's getting a yield. I've covered this before on my channel, but I'll just briefly go on Lido's website. Lido issues the Wrapped staked ETH token, and you can see here that staking yields are about 4.6%. That's a good number to remember for just a minute. Now, normally this wouldn't be possible. Lido's original staked ETH token was a rebasing token, which means the amount of tokens that you had in your wallet would automatically increase every time yield was generated on your assets. Now, they have since come out with a Wrapped staked ETH token, which means that token isn't rebasing, it just accrues yield in the underlying value. The benefit of that is this asset can now be used in smart contracts, and in Maker's case, we can now borrow against this yield-bearing ETH token. I'm going to enter Wrapped staked ETH's borrow tab, and the really cool thing about this vault is you're essentially always going to be getting paid or accruing a positive yield while you're borrowing. Now remember, that Wrapped staked ETH that's sitting in Maker is going to be earning about a 4.7% APR, and any DAI that you borrow, so you're not actually paying a fee on your collateral, but any of your borrowed DAI you're paying a 3% yield on. So no matter how much you're borrowing, you're always going to be getting a positive yield on your ETH, and that's going to outpace the interest payments on the DAI. Now, I know Alchemix is a favorite of people. Essentially, you can get a yield on your ETH and borrow against that yield in a non-liquidatable fashion, but I actually think this is more compelling of a product than Alchemix. Now, the reason being is simple. If you use Alchemix, you have to borrow in the same asset. So if you put up ETH as collateral, you have to borrow ETH against that ETH, whereas with Maker, you can borrow DAI or stablecoins against your ETH, which is hugely advantageous. The reason this is advantageous is if you go to Alchemix and you decide to borrow against your ETH, then if you want to do anything with that ETH, if you sell it to another asset like a stablecoin to yield farm, you're effectively shorting ETH. What that means is if the asset you traded your ETH to underperforms ETH, you're going to actually have to purchase more ETH back than you might be able to afford, so you're going to be kind of underwater. I also think it's worth noting that Alchemix's yield for ETH is now pretty much the same as Lido's. It's actually slightly lower, and this basically ties in with my theory that pretty much all safe, sustainable ETH yields will compress to the same market rate. So with Alchemix, it's not like you're getting a better yield on your ETH, but the plus side is you can't be liquidated on Alchemix, where, as I'll get into in a minute, you can be liquidated on Maker. The reason being, of course, with Alchemix you borrow ETH against your ETH, whereas with Maker you borrow DAI against your ETH. Now, although Maker doesn't advertise it, of course this Wrapped staked ETH vault is effectively a self-repaying loan as well, just because the value of your collateral is always going to increase faster than the value of your borrow. Now, before I walk you through an example, it's important to note that one Wrapped staked ETH is not going to be equal to the price of one ETH. It's actually going to be higher. So right now ETH is trading at about $3,000, but Wrapped staked ETH is $3,100. And the reason being is because Wrapped staked ETH is always going to be accruing value or accruing more ETH because it's being staked. Now, to start with an example, let's just assume that we want to put up 15 staked ETH as collateral. That's about $47,000, and we want to borrow stablecoins against that. So I'll click Generate DAI, and if we're looking to compare this to Alchemix, I'll borrow about 1/4 of the value of my collateral. So in this case, I'm borrowing $12,000 or 12,000 DAI. So right off the bat here, we can see some crucial information. The most important number you're going to want to pay attention to is your liquidation price here. And in this case, if I'm borrowing about 1/4 of the value of my collateral, the liquidation price will be about $1,280. What that means is if this Wrapped staked ETH token drops to that value, I'll get liquidated, which essentially means that Maker will have to sell off part of my position or actually auction it off to make sure that the debt is paid down. And there is a 13% fee on top of that. So you kind of get a haircut on your position, and then you take an additional 13% penalty for being liquidated. If you're pretty confident that Wrapped Staked ETH won't dip below this price, or I should say ETH won't crash down to around this price, then this would actually be a better option pretty much than Alchemix. And the reason being, again, is because you don't actually have to sell the borrowed asset or the ETH in Alchemix's case, which is effectively shorting ETH. So in this case, you're generating the stablecoins instantly, and then you can kind of do as you please with the stablecoins from there. Now, the cool thing about this is if you're yield farming that DAI, and you're actually able to get higher than a 3% borrow fee, which is what you're paying on the DAI, then you're going to be making a lot of money collectively on your entire position here. So remember, your ETH is earning 4.6%. You're borrowing some certain amount of DAI that's safe. You're paying 3% on the DAI borrowed, and then any of the yield after that you get from yield farming goes straight to you. So in this case, you can really stack a lot of yield. Now, if you were using Alchemix, obviously you have the option to try to find a yield on that ETH that you borrowed, but yields for ETH, as we've discussed, have come down to about 4.5%, so you're not getting much of a boost there, and you're kind of better off borrowing the stablecoins. It's also worth noting that MakerDAO is pretty much the most trusted app in DeFi. It's been around the longest. It's really a fixture of DeFi, and although it's not as sexy as some of the new apps being built, it is very trustworthy, so you can definitely trust your assets here just as much as you can with any other platform. I want to point out that with Maker, there are other assets you can post as collateral that are yield-bearing, and those are these Uniswap V2 positions that you can put up as collateral. Now, I've actually looked at pretty much all of these Uni V2 positions, and none of them are really earning too great of a yield. Just for example, let's take a look at this DAI ETH position. So we can switch over to Zapper. You can see you can type in DAI and then scroll down to the Uniswap V2 DAI ETH pool, and you can see the 1-year APR is only 4.7%, which isn't great. I will say if you're comfortable with the IL risk, the advantage to this asset is, of course, it's going to be less volatile in price relative to ETH, just because it's always going to be pegged or balanced with a stablecoin. When you discover this video and you're checking yields for these Uniswap V2 LP positions, you can kind of just find these on yourself on Zapper because, of course, the yields are volatile and they do change over time. So why now? Why am I covering Maker now? Why am I covering Wrapped Staked ETH on Maker? Well, it's certainly a volatile time in the markets, and I think Maker kind of provides a haven for all of this volatility. If you're dollar cost averaging into ETH and it's starting to become a large portion of your portfolio and you need access to dollars, if you keep it safe, this is a great way to borrow against your ETH without having to sell any. So how am I using this? Well, for me personally, I love getting a yield on ETH, so I'm happy to be in a Wrapped Staked ETH position. And then I'm also pretty good at finding stablecoin yield farming opportunities, so I borrow a healthy amount against my ETH and then farm it at, call it, a 20 to 25% APR on top of that. Now let's just assume you borrow 25% of your position values, which I would argue is safe. So if you put your Wrapped Staked ETH up, you're getting about a 5% yield on that. And let's just say you can get a 20% yield on your stablecoins, which shouldn't be too hard to do. Your total yield is going to be roughly 10% on your ETH position. Now, I'm really happy with that personally. I think ETH has a bright future ahead, and if I can get a 10% yield on a really attractive asset, I'll do it every time. So hopefully this rundown of Maker wasn't too boring for you. I know it's not as exciting as some of the more degen plays out there, but I do think it's a useful strategy if you've amassed a lot of ETH and want to continue staking it. Now, with that said, thank you all so much for watching, and I look forward to seeing you all in the next video.